Welcome everybody. Now, as you all know, this webinar would basically focus on technical analysis on commodity markets and how a trader can trade, track and make profit in the commodity markets. The whole webinar would be moved around the trading strategies in commodity market, some basic technical analysis parameters in the commodity market, and some live examples from a technical analysis software as to how you can use technical analysis while you are trading in the markets. So let us begin the webinar. Now this will be the content flow, basic need of the webinar, why exactly we needed this webinar and the reason why we are conducting this webinar, basics of commodity trading, trading strategy in commodity markets, and then technical analysis in commodity markets. This would be followed by a question and answer session. So anybody who has any question, they can note those questions down, and at the end of the webinar, we will be taking a Q&A session where we will be answering all the queries of all the participants. Now, need of this particular webinar. Now, we have met many traders who trade in the commodity markets. Some traders are trading for a very long time in the commodity markets. But 90% or in fact 98% of the traders which are trading in the commodity markets are making losses. So why is the reason that whether the commodity rises or falls, a retail trader is always in a loss? Why is the retail trader not able to take the profits out of the table when when the market is moving in his particular trend? So if the market is falling, he is long. If the market is rising, he is short. So why is the reason that the traders are not getting into the profits? Also, the irony of the Indian financial market is that a trader does not have a successful life more than 6 months. After 6 months, he'll either stop trading or he'll close his demat account or maybe trading account and come out of the markets. New trader comes in the market with the same hope that I'll make the money, but then again he shuts down his trading account. So in our country, almost 87% of the traders become inactive after the first 6 months. So let's say if I open a trading account with a broker today, after 6 months I'll be inactive. I'll be not trading in my trading account. And this would mainly because I've suffered losses in the markets. So we highly felt that this webinar should be done to educate, to train all those who are in the markets, all those who make the traders trade in the markets, the dealers, the RMs, the branch managers, the regional managers, the portfolio managers, everybody who is there in the market should be trained sufficiently before allowing them to go and interact with the end trader. The traders normally what they do, the dealers and RMs what they do, okay, this is the call, just trade on this call. There is no stop loss, no target. Stop loss hits, they'll not call to the trader because they are feeling shy that okay, if we call to the trader, he'll be scolding us. If the target hits, he'll not call to the trader because he wants that the trader should sell at a higher price point. So this is the main reason why the traders are making loss in the markets. Fear and greed. So the fear which is there in the market, it will not make you enter in a trade if you feel that the market is going good. And the greed which is there in the market will not let you book the profits. The end result is that the profit was there on the cards, but you didn't took the profit and now the market is again down. So this is why we felt that we should do this particular webinar. Now, why investor education? The need of investor education in this country, in this market. Now let us take a very simple fact which I have put in there in the screen. Today almost 95% of the retail investors lose money in the markets, and those 5% who make money are the intelligent guys in the markets. So remember, this is a very zero sum game. So if I am losing money, somebody else in some corner in the market would be making money on the trade. So why isn't that I am losing and I am not on the winning side? It is not the profit is leaked out of the market, or it is shrunk out of the market, it is sucked out of the market. If I am making loss, somebody else will make profit, and vice versa. So in India, less than 3% of Indians are currently exposed to the direct equity markets. In the country of 120 crore people, less than 3% of them are directly exposed to the equity markets. Why is the reason so? I mean, when we talk about the developed markets like USA, UK, 44% of the total savings go into the equity market. And in here, 57% of the total money saved is still kept in the saving account. Some is being spent on the insurance policy, some is spent on the property, some is spent on the gold, and very few of that particular proportion which is being spent is invested in the equity markets. On the irony, if we see the last 6 months performance of any stock, maybe Nifty or Sensex or maybe mid-cap counter, they have given huge return. Now there is another theory that you cannot time the market. A trader would come out and tell you, okay, so when should we buy a stock, when should we sell a stock? So frankly speaking, a trader with very little knowledge cannot time the market, but a trader with a bit of intelligence can surely and perfectly time the market and invest in the markets. We cannot say that he'll be buying at the bottom and he'll be selling at the high, but yes, the news, the analysis tools which are available in the markets are fair enough to tell the trader that okay, this is the right time to enter and this is the right time to exit from the markets. So for an example, you keep your money in the saving account which fetches you around 4% interest on an year. We take the inflation as 7% per year. So you are getting a negative return of 3%. So the return at the end of the year would be minus 3%, which is that same commodity is now costing you at 107 and your saving account has given you only 4 rupees return. So that excess 3 rupees is still being paid from your pocket. So this is why you should not keep your money idle. So if your money sleeps in the saving account, your future will also sleep. It does not compulsorily state that you should always invest in the market. You should every time you should invest in the market. No, there is a systematic investment plan, a beautiful instrument known as mutual funds. I guess everybody of you in this webinar must be knowing what a mutual fund is. That's a beautiful instrument. Now let's say we are sitting on January month, the tax saving season is very close. We start hunting of the instruments at this particular point in time, February, March, and then here the NAVs are at all-time high. Why didn't we invest in that ELSS fund or that ULIP for that matter when the markets were at the bottom? 5200, 5300 Nifty was there. We knew that we had to invest for the tax saving in this particular year, but we didn't invest in the markets. So this is the irony of an Indian investor, and we need such investor education campaigns very aggressively and very frequently to educate that trader in the financial market domain. Let us move to the next slide. Now we are coming to the main POA or main KRA of this particular webinar, which is the commodity trading. I'll be briefly stating you the basics of commodity market, what a commodity market is, and how can you trade in the commodity markets. So the regulator of the commodity market is FMC, also known as Forward Market Commission. There are currently two exchanges, MCX and NCDEX. MCX is multi-commodity exchange and NCDEX is National Commodity Derivative Exchange. So mainly non-agri commodities are traded in MCX, which runs till midnight, and the agri commodities are traded in NCDEX, which is still 5 p.m. of the day. Now coming to the types of the commodities, as you can see, there are 4 types of commodities: precious metal, base metal, copper, nickel, zinc, aluminum, lead, etc., energy, which is crude natural gas, and agriculture commodities, soybean, jeera, chana, menthol, etc. Let us move to the next slide, which is basics of commodity trading. Now the instrument type which is being traded here is future contract. Margin is between 5 to 10%. It depends on the volatility of the counter. Settlement happens on T+1 basis. Expiry is 3 to 8 months. Positional short selling is very much allowed in this market. Non-agriculture commodity are directly linked to the US market. So if we talk about gold, silver, copper, crude oil, all these non-agriculture commodities, they are directly linked with the international markets, US, UK markets. Agriculture commodities mainly linked to the Indian markets and with an effect of global markets too, a slight effect of global markets. Let us move to the next. Now as you can see on this particular page, what we have mentioned is that what is the irony or what is the scene of a retail trader in the markets. As you can see, a retail trader who unfortunately buys at the high and unfortunately again sells at the lowest point. Why is that the trader, a retail trader, buys at the high point and sells at the lowest point? So this is the irony of a trader. You always get stuck at the highest point. Let us ask some questions from ourselves before moving to the core content of the webinar. Now the first question is that, has every trader on the street lost money? Each and every trader, has he lost money? No. The point is that not every trader in the market has lost money, because if I am losing money, somebody else on that side is making money. So not every trader on the street has lost money. Is making money purely on luck in the markets? No. Making money is not purely on the lucks in the market. So if you have a proper trading strategy, you will make huge money. If you don't have a proper trading strategy, your stop losses are not on the place, you will not make money. Is there something known as trading strategy or technical analysis in the markets, and do they really work? Yes, there is a proper trading strategy. We all hear those strategies in TV. We all read in newspapers several times that what is a trading strategy, how you can trade in the markets, what is a stop loss, and they really work in the market. Can a retail trader really earn and sustain for a longer time in the markets? Yes. If he keeps on trading with a proper strategy, proper technique in the markets, he can surely make money and stay in the markets. Do stop loss really work? Yes, they really work in the market. The best example is go out and talk to at least 10 clients who have stopped trading due to the losses. 9 out of them will tell you they are in the losses because they have not put any stop loss on their trades. And what is a trailing stop loss strategy? So we'll be covering this trailing stop loss in our subsequent slides. Let us move to the next slide. As you can see, this is the slide which explains how technical analysis work. Now, as you can see, I have highlighted a price point. Here, this particular counter has found a resistance at this price point. This stock then again fell, and then that stock broke this particular resistance with good volumes, almost all-time high volumes. He broke that particular resistance. We can also see that the counter has broken above the moving average with huge volumes. Again, huge volumes were there. So this is a very simple technique of how you can work through technical analysis in the markets. A risk return appetite. What is a risk return appetite? As they say that you should measure your risk clearly before entering into the markets, and you should have a proper risk to return parity before entering into the markets. Ideal risk return strategy is 1:3, which means that if you are making a loss of 1 rupees, you are ready to take a loss of 1 rupee, you should be at least aiming for 3 rupees profit on that particular loss of 1 rupee. This is an ideal trading strategy. Normally what happens with a retail trader, that the trader enters the market with a simple view that okay, I'll be making the profit, but he does not know what is the stop loss, what is the target he has kept in the market, and he simply buys a share. So let's say if he has bought a share at 100 rupees. He thought that okay, I'll be making some profit in the markets, but he does not know what is the level of profit he'll be making in the markets. So it could be 110, 105, 102. But he is not very clear that what is the profit, what is the magnitude of profit he'll be making in that particular trade. So a trader should clearly write down, note down his risk return parity. Okay, so I am buying a share at 100, my stop loss should be 97 and target should be 110. So this is what a trader is expected to do. Before every trade you enter, you should clearly write down your stop losses and targets on a piece of paper, and then you should succeed to the trading desk. Before writing down, before knowing what are your stop losses, what are your profit potential, you should never and do not enter into the markets. This is a fantastic example of how you can keep on booking your profits. Now what I have done is, this is a share. I got a buying signal on this particular price point. So I bought a share because that was a double moving crossover. But what I did was, I didn't knew where the share would reverse again. At this point in time, it was almost May of the year, May month. I didn't knew that the share would reverse or the commodity would reverse in September. So what I did was, I kept this moving average line as my trailing stop loss. Let's say I bought 1000 shares here. I kept on booking profit. So I sold 250 shares here, again 250 shares here, again 250 shares here. And then when I saw that the market is now reversing and there is a reversal signal on the charts, I sold all 250 shares. So I booked all my profit in this particular range. So this is how a trailing stop loss works fantastically. So simple moving average would help you ascertain your trailing stop losses, and that's how you can trail the stop loss, take the maximum out of the markets and trade in the markets. Now we move on to the next slide, which shows us the leveraging effect. Now that is again the most common, I would say, trading disease in the trader, that he asks for huge leverage. Normally what traders do, they fight with the brokers that okay, I want a limit, I want this much limit, I want that much limit, give me this much limit, give me that much limit. He fights, literally fights with his broker that I want huge limit out of the markets. The point is, as much limit you have, as much you are exposed to the risk in the markets. So an ideal risk leverage effect should not be more than 4 to 5 times. What a trader does is he invests 1 lakh rupees and asks for a 20 time limit, which is 20 lakh rupees. So let us understand it this way. What I have done is I have bought a commodity worth 20 lakh rupees. Now a 5% loss in that particular commodity would erode my 100% capital, which is 1 lakh rupees. So let's say I bought a commodity worth 20 lakh rupees. A 5% loss, which is 1 lakh rupees loss, is taking away 100% of my capital. So this is how badly a leverage can backfire to a trader. So a trader should be very, very careful before taking excess leverage. As we say in the markets, if you know that you are making losses, why to take extra limit? Because every extra limit you take would multiply your loss. Always advisable for a trader that they should not take extra leverage in the markets. Take nominal leverage, trade only on a very, very sure call with a proper stop loss when you take a leverage in the markets. So the trader should always advised that not to take extra leverage in the markets. Now understanding the stop loss. We are moving to the next slide, which is understanding the stop loss. Now there's a fantastic picture which is there on your screen. I guess everybody must be viewing that particular picture which is there on the screen, which shows how a stop loss literally works. As you can see, a trader, a jumper is jumping from the cliff and he is hanged by a rope which acts as the stop loss for that particular trader. This is what a stop loss does to a trader. A trader is always secured, always safe. He knows that okay, I'll be safe if anything bad goes, if anything goes wrong, I'll be safe with that particular rope. So the same way a trader would be more confident, more fearless in the markets, and more tactical in the markets if he has put in his stop loss, because he knows that okay, my loss would not be more than this particular price point. So this is my stop loss, this is the maximum loss which I'll be making, and that's it, full stop. Let me move fearless, confidently in the markets and trade in the markets, take my decision without any fear, without any bias, without any risk of losing money in the markets. So all my decisions would be right, fearless, and they would turn up in the profits. We do not say that the stop loss would never trigger, and we are happy that if the stop loss gets triggered, because if the stop loss are getting triggered in number of times and again, it simply means that there is something seriously wrong with your trading strategy. We have put in 10 trades and all the 10 stop losses got triggered simultaneously. You should ideally stop trading for next 1 week. Think about what is your trading strategy. Consult your trading advisor, equity advisor, commodity advisor, and then come back to the markets with a very, very small capital. But the solution is not to shy away from a stop loss. Stop loss are there to get triggered. So if there is a share or a commodity which is highly volatile, you should keep a bit broader stop loss. If there is a high momentum trade, or it is a trending security, you should keep a smaller stop loss. So ideally your stop loss, deciding your stop loss is not simple maths, 1 plus 1 is 2 or 1 is to 3. In fact, the stop loss should be taken very, very carefully by taking a high look at the markets and clearly seeing what the support, what are the resistances of the stock, what are the moving averages, RSI, stochastic, all these indicators say about the stop loss, and then the stop losses should be put in. The stop loss is not a simple 1:3 match. So let us move ahead. As you all can see, this particular chart, this chart is showing what a support is. Now simply stating, a support is a point where two troughs are the bottom of a particular chart, where two troughs join each other. So here you can see there are two troughs, they are coinciding at the same price point. This is first trough and this is the second trough. As you can see, this stock has found its support fantastically and has retraced from that support upwards. So this is how a support works. Now let us see what a resistance is. On this particular slide, we will be seeing what a resistance is. This is first resistance and this is the second resistance. These are two resistances, first and second resistance. So as you can see, any price point where there is a supply or a selling pressure on the counter and the counter stops rising, it is known as a resistance point. Now let us understand what a trend line is, how a trend line is drawn, what a trend line is, how the trend line works, and how a trader can effectively use trend line while he is trading in the markets. As you can see, what we have done here is that we have joined the resistance of that particular stock with a line, and when the line is being joined, it looks like a trend line on the stock. Let me explain you with a highlighter. This was first resistance, second resistance. The share is falling continuously. Third resistance, fourth resistance. So this is how you can see that, okay, the share is falling. There are multiple resistances and the line which is being drawn, this particular line from here to here, this is the trend line. This particular blue line is known as the trend line. As you can see, this is clearly indicating that this is the trend line. So it's a very simple method to draw a trend line. Now a support line. There are two kinds of trend line, a support trend line and a resistance trend line. Now as you can see that three supports are there and three. These are three supports which are there on the counter. What we have done is we have joined the trend line by joining these support points. These are three support points. We have joined the trend line by joining the support line, and this is known as the trend line. This is the trend line of the stock which we have drawn. Now these trend lines could be drawn intraday, daily chart, weekly chart, monthly chart, yearly chart, or any kind of chart which is being there. These trend lines could be drawn. Now let us understand how you can generate a buying or a selling signal by joining a particular trend line. As you can see, what we have done out here is we have made a resistance trend line by joining the peaks, peak 1, peak 2, peak 3, peak 4. And when the stocks break above this particular line, we generated a buy signal on that counter and the share went above. So this is how you can use a trend line for generating a buying or selling signal on the counter. Now this is how a sell signal can be formed. As you can see, what we have done out here is, again we have joined three support lines, 1, 2 and 3. We have made a trend line. The trend line intersected the stock at this particular point and there was a sell signal generated. So this is how you can use a support trend line. Now again I'll be reiterating that these trend lines could be used in intraday, daily, weekly, monthly or yearly chart, or for that matter any time period you can use these charts for. Now this is a horizontal trend line, a fantastic way of generating a support. Now here what we have done is we have made a horizontal trend line, a trend line where the supports are almost at the same price point. This is known as the horizontal trend line. This acts as a support for that particular counter. Now this is how an angular trend line is. This particular trend line is in a particular angle. This is known as an angular trend line. These are simple kinds of trend lines which are being seen in the trading. This is a long-term trend line. The long-term trend line can range from 2 to 20 years. A very, very long-term trend line. As you can see, the trend line is almost covering 3 years, 2009 to 2010, 12. This trend line is moving from. These are short-term trend lines. It could be for weeks, it could be for days, it could be for minutes also. So a long-term trend line and a combination of a short-term trend line. These both trend lines combine and then the buying or selling signal is being generated. As you can see out here, these are very, very short duration trend lines which are being drawn here, also known as internal trend lines. This is a trend channel, a range or a pair or a trading range where a trend line is being drawn. So as you can see, whenever the stock touches the top, it reverses back, it touches the bottom, it goes above. So this is known as a trend channel. This trend channel can be drawn in any share, any commodity or any currency for that matter. These are very, very short-term trend channels. As we have shown you some small trend lines, medium-term, long-term, short-term trend lines. These are short-term trend channels. Okay, so now from the trend line, let us move on to the moving averages. So it's a simple, moving average is a very, very simple technique wherein if the stock moves above the moving average, it gives a buy signal. If it moves below the moving average, it gives a sell signal. So that's a very, very simple technique. If it moves above, buy, below, sell. Now let's see on the next slide. These are simple moving averages with different time periods. This is a 7-day moving average, it's a 21-day moving average. So a chart could be coincided with either a 7-day moving average or a 21-day moving average or a combination of both the moving averages. So these moving averages act as a double or triple confirmation for that particular counter. So let's say a share has broken above the 7-day moving average and it has again broken above a 14-day moving average. So it's a double confirmation on that counter that okay, the share is trending above with a double confirmation. Now let us see the next slide where the moving average is used as a support and resistance. Now this is the 35-day moving average which is acting as a resistance and again that same moving average, when it broke above from this particular price point, here it gave a buy signal. It break above that moving average line, and then the same moving average line is acting as a support, which was acting as a resistance. The same moving average line is acting as a support. So a trader can easily use this moving averages line as a trailing stop loss. So let's say if he is short at this point, which is almost 900 odd point, he can trail this stop loss all the way till 350. So he has short at 900, he can gain the same profit till 350. The stock broke above this particular price point, he went long on the share, and then he is taking the advantage of the long trade again with that same moving average. So the same moving average, it's a very simple technical technique, but a very fantastic and very useful technical technique when we come to the technical analysis of the commodity or the equity market. Now let us understand RSI, relative strength index. A relative strength index is a line which moves from 0 to 100. If it is above 70, it is an overbought. If it is below 30, it is oversold. Whenever the RSI moves above the 30 line, a bullish trend is confirmed. If it breaks below the 70 line, a bearish trend is confirmed. Let us move to the next slide. It simply shows how you can use RSI in the regular trading techniques. As we can see that the RSI is below 30, which is the oversold region, above 70, which is the overbought region. So this simply states this is the RSI line, this is the stock, underlying stock, and this RSI line moves from 0 to 100 line. This is a percentage line. Overbought region, oversold region. Next slide, which simply shows how you can generate a buying and selling signal. Let us see here. When the RSI moves above 30, it gives a buy signal. The RSI is moving, it went to the overbought, it broke below 70, it gave a sell signal. Again, when the RSI broke above 30, it gave a buy signal. When the RSI broke below 30, it gave a sell signal. So it's a very simple and easy technique which is known as RSI, relative strength index, where we use this RSI in our regular trading, and this particular indicator could be used very effectively in intraday, daily, weekly or hourly charts. Now this is again another example how you can use the RSI. What we have done is we are not waiting for the 30-70 line to be broken. We have drawn trend lines on the RSI. As you can see, these are the trend lines which are drawn. The counter breaks above the trend line, it gives a buy signal. It breaks below the trend line, it gives a sell signal. Sorry. Sorry. Again, if it breaks above the trend line, it gives a buy signal. Again, it breaks below the trend line, it gives a sell signal. So what we have fantastically done is we have used the RSI on its basic principle, which is 70-30, and again we have used the same RSI with the trend lines. So that was all about RSI. Let us see another indicator which is known as stochastic oscillator. Now this stochastic oscillator, it is a very primitive indicator but very effective indicator. There are two lines, one is known as percentage K, another is known as percentage D. We will be not going deep into the calculation, but percentage K line is the baseline and percentage D line is the simple moving average, 3-day simple moving average of the percentage K line. This again indicator, this moves from 0 to 100 point. Let us see how this indicator is being used. If the indicator is above 80, it is overbought. If it is below 20, the same indicator is understood as an oversold indicator. So now before moving to the stochastic oscillator, we have seen so many indicators. We have seen trend lines, we have seen moving averages, we have seen stochastic oscillator. We will be seeing it now. So as you know that technical analysis is all about combining indicators. So a successful technical analyst combines all the indicators and then uses that particular trading signals with a perfect confirmation on the charts. So an ideal combination is moving average, trend lines, RSI or stochastic oscillator. Although there are 50 to 100 several indicators in technical analysis, but I would personally prefer not to use each and every indicator and stick to 2 or 3 indicators and master my art of technical analyst as a technical learner in 2 or 3 technical indicators. So let us see this particular use of stochastic oscillator. The above 80 region is known as overbought, below 20 region is known as oversold region. As you can see, this is the K and D line. A fantastic example of a sell signal generated here is when the K line moves below the D line, or simply stating the baseline moves below the moving average line. It gives a sell signal. When the baseline moves above the moving average, as you can see, percentage K is above the percentage D line, it gives a buy signal. And the same is being generated numerous times here, and you can generate a buy and sell signal on that particular counter. So as you can see, that stochastic oscillator, or for that matter RSI, these are very simple techniques, very simple indicators which can be used in the markets on a very regular basis. And a trader or a technical analyst, or for that matter RM, dealer, relationship manager, or a branch manager, or a portfolio advisor can make the trader earn huge profit in the markets. Very simple techniques, but again a trader has to do huge practice on the technical analysis, and then they should use those techniques on the daily trade. With this slide, we are now shifting to the next part of our webinar session, which is the Q&A session. Now I'm very sure that most of you must be having many queries in your mind. What is this technique, what is this tool? Request anybody who has a query, they should type that query in the chat section, send that query to us, and we'll be more than happy to answer those queries. So the forum is now open for the chat session. If you have any query, do write into us to query in the chat section. In the right hand side column, you will be seeing a chat or a query section. Put in your questions then, and we'll be answering those questions. We have received a query, how to calculate RSI. Simply stating, RSI has a formula which is not been discussed here. The simple reason is that you do not have to calculate the RSI. You simply go to a technical analysis software and indicate or implement an RSI. A simple thing which you have to understand is that when the RSI moves above 70, it is overbought, below 30 it is oversold. That is a simple technique or simple thing which you have to keep in your mind. Please send any other query if you have. We have got another query. What is a leading and a lagging indicator? That's a fantastic query and a very commonly asked query in my technical analysis sessions. A leading indicator is an indicator which is more or less based on the momentum, like an stochastic or an RSI, which gives an advanced signal to the trader. A lagging indicator is an indicator which gives a signal when the stock has already moved a bit above that particular price point, which is moving average. So moving average is a lagging indicator. Leading indicators are MACD, RSI, stochastic, etc. Okay, another question, what other technical charts we can use? There are many different charts which are there. You can go to the NSE website, you can go to the MCX website. There are many free charts available, iCharts, and many other free websites available on the markets to use the technical charts. Okay, there is another question which says to explain about moving average. So let me go back to the moving average slide and explain you what moving average is. So I'm explaining this particular query because I have a query on a moving average. Simply stating, a moving average is a line which moves along with the stock or the underlying asset. If the share moves above the counter, it gives a buy signal. If it moves below the counter, it gives a sell signal. That's a very, very simple explanation of a moving average. So a moving average is nothing but an average which is moving daily. Why we call it moving? Because let's say if I am taking a 14-day moving average. So every 14th day or every trading session, the moving average would either rise or fall. Okay, so which stock or commodity we should use which moving average? Although this is a very, very personal technique, every trader uses different moving average for every indicator. But bullions, you should use 7 and 14-day moving average. For base metals, you should always use a combination of 7 and 21-day moving average. We are also receiving some questions for the trend. What is the Nifty trend? What is the USD INR trend? I should clearly share with you that this webinar is not for asking the trend. So please do not ask what is the short-term, medium-term trend, because this is a purely educational webinar. So request anybody and everybody not to ask any trend about Nifty, USD, INR, etc. Please. Okay. Another question is simple or exponential moving average. So ideally, the traders use a mix of simple and exponential, but personally, I would prefer using simple moving average. Okay. Another good question. What is advisable 5-day, 5-minute, hourly, or a day chart? So when you are using technical analysis on intraday, it is always advisable to use a 5-minute chart or a 10-minute chart. When you are using the technical analysis for a 2 to 3 day positional call, you should use a 30-minute chart or an hourly chart. Okay, what about candlestick? Candlestick is another type of chart which is similar to a bar, wherein high and lows are being indicated with the help of a candle. Okay, another question, in chart which time frame is suitable? As I already answered, that in a chart you can use either 5-minute, 10-minute, 30-minute or 60-minute. Okay, which is the free website chart for commodity? iCharts.in is another free website for commodities. You can go in there and use it. Commodityface.com, commodity.com is another free website for technical analysis. For intraday charts, you need to visit any website. As far as I know, no intraday chart is available free of cost. You have to subscribe to these websites. Another question, that among all these charts, which is the chart which gives more accuracy? I mean, this again depends on the trader, but bar chart is a chart which gives more clarity, more information to a trader when he is trading. Okay. Any fundamental website? There are many fundamental websites. Commoditycontrol.com is a fundamental website. Forexfactory.com is again a fundamental website. Okay. Another fantastic question, and a question which always occurs in the mind of a technical analyst is, what should we do if two techniques are giving conflicting signals? First, let me explain when this condition occurs, and secondly, what should a trader do? So let's say there is a stock which has fallen drastically in the last few trading sessions, and in the recent 2-3 trading sessions it has given a slight buy signal on the RSI, but on the 14-day moving average the counter is still not giving a buy signal. What to do then? Best way is to wait until you get at least 2 trading confirmation from 2 different leading and lagging indicators. So good technical call is a call which is always based on at least two trading session, two technical indicators. Okay, a question which almost every retail investor trader asks. This question is, that market movement depend on fundamental or technical? Sir, it depends on both. But you as an analyst have to choose one way, whether you want to go fundamental or technical. Another question, how inventory report affects the market? Now, it's a very simple or a thumb rule which is being followed globally. So let's say if the inventory of a commodity is more than what it was in the past time or what it was expected, the commodity will tend to fall. And if the inventory is less than what it was expected or it has decreased, it would tend to rise. So that's a simple answer of how the inventories affect the commodity markets. Please feel free to ask any other queries if you have. And I would request that you should be very specific while answering your queries. I am getting some very incomplete queries. What about energy sector? I mean, as a speaker, I am not able to understand what the trader or what the participant is being asking. So please be very specific, very detailed in the queries which you ask. Don't ask queries which are very unclear about asking. So please ask very clear queries. And the queries are to be asked only via chat, so no mic facility is being available. I'm getting some questions that please activate the mic. The mic facility is not there. Okay, another question, How volume decides buy or sell signal? So volume acts as a supplement indicator to the base indicator for a technical analyst. So for example, I have generated a buy or sell signal on the charts via using an RSI or a moving average breakout or a breakdown. Now if the counter has seen an RSI or a moving average break up with huge volume, that volume indicates that the call which I am going to give is being supported by many other traders in the market. So it acts as a supporting factor or a double confirmation or a triple confirmation to my technique. So if there is a call, if there is a signal which is there, but the volume is not supporting that particular signal, so you should ideally wait for that volume, or you should wait for a lagging indicator like moving average to give a confirmation. Okay, a question about candlestick pattern. So there are different candlestick pattern. A candlestick pattern is known as doji, hammer, hanging man, and there are different patterns. Although this session is not focused on those candlestick patterns, so there are different patterns in the candlestick charts. Okay, another question is, when the inventory is out, what is the best strategy to trade? Ideally, what I do or I prefer is that I do not trade when the inventory is out, or 15 minutes plus and minus when the inventory is there. Because when the inventory is out, 15 minutes plus and minus are very volatile. 90% times you will make loss. 90% times. So I would advise a trader not to rely much on inventory. That's a very occasional phenomena. These come and go, these inventories come and go. Learn proper technical analysis, rely on your technical analysis, believe on your technical analysis, and always use your technical analysis for trading. Every technique is good, every technique is bad. If you don't know how to use it, it is bad. If you know how to use it, it is good. Okay, another great query on how to calculate and where to place stop loss. Is there any formula for that, sir? Let me explain this to you with a slide where I used a trailing stop loss. Let me get that particular slide. Okay. As you all can see, what I have done is I have used the moving average line as my stop loss. The perfect formula for deciding the stop loss is via the moving average, RSI, or any technical indicator which you use. I would rely on trend lines and moving average as the perfect way to put up a stop loss. So I have bought the share here, and then this moving average line is acting as my stop loss. So whenever the line is being breached, as you can see, the moving average line was breached here, so I exited from this particular pointer counter. So whenever it moves above, I'll buy. Whenever it moves below, I'll sell. Again, there is a query that if you want to trade in inventory session, what is this strategy? Personally, I would not advise to trade in the inventory period. The markets trade for 13 hours, 13 and a half hours. Why to put yourself in a situation where you are prone to the inventory data? Who knows what is the inventory data? What will be the reaction of that inventory data? What was the expectation? So if the client want to trade in inventory data, as an intelligent person, you should stop them to trade. This is my advice. Feel free to ask any other queries because we are nearly ending this particular webinar. So if you have any query, please put in the queries. We will be taking last few queries. Okay, so as we don't have any other further queries, we would like to end this particular webinar session. We will thank you all for attending this particular webinar. We hope that this webinar was useful to you all, and you will be using these technical analysis techniques in your regular trading. You will be trading yourself good, and you will be helping the traders make profit in the markets. Thanks from our side. We wish you all the best for your trading and happy trading. Thanks.